Let's talk about a strange reality. Markets are hitting all-time highs, headlines are euphoric, and everyone online seems to be making a fortune. But beneath the surface, countless retail investors are actually losing money, even as the indexes soar. Their portfolios are in the red while the market is painted green. It's a silent epidemic. Losses in the middle of a boom. So, why are so many losing when the market is winning? It's not bad luck or a rigged game. It comes down to psychology, timing, and a few critical mistakes. Today, we'll break down those mistakes and reveal the strategies that help smart investors thrive, not just survive. The first big mistake: believing a rising tide lifts all boats. When the index climbs, it's often just a handful of mega-cap stocks driving the gains, while many others stagnate or fall. Remember the IPO frenzy with Paytm and Zomato? Investors bought at peak hype, ignoring fundamentals. Paytm crashed, Zomato corrected, and those who bought at the top faced huge losses, even as the Nifty kept rising. A bull market doesn't make every stock a winner. Euphoria blinds people to real value. They chase stories, not numbers. Buying overpriced, overhyped stocks is a fast track to losses. The lesson: stock selection matters more than ever in a bull market. Don't assume your pick will rise just because the index does. Do your homework, know what you're buying, and never pay any price just because the market is hot. It's not about the tide, it's about the boat you're in. Next up, the FOMO trap. When everyone else seems to be getting rich, it's easy to panic and jump in without a plan. This is when most people buy at the top, driven by anxiety, not logic. Take the Sensex run-up in 2007. Latecomers bought at the peak, then the 2008 crash wiped them out. They missed the gains, bought high, sold low, and then stayed out for years, missing the recovery too. FOMO leads to buying high and selling low, the exact opposite of what works. The pain of missing out on gains is nothing compared to the pain of real losses. Emotional investing is a vicious cycle. The key: don't let hype dictate your entry. Have a plan, stick to it, and remember, opportunities always come back around. Strategy beats panic every time. Bull markets make everyone feel like a genius. A few quick wins and suddenly you're trading constantly, chasing every uptick. This overconfidence leads to overtrading, buying and selling too often, racking up fees and taxes. Even if your picks are right, costs and bad timing can erase your gains. Studies show most traders lose money, not because their picks are wrong, but because they trade too much and let emotions rule. Overtrading is a slow bleed. Your broker gets rich, you take the risk. The market's momentum won't last forever. Discipline, not activity, builds wealth. Don't act like a gambler in a casino. Hold quality for the long term and let compounding do the work. Remember, the real winners are patient, not hyperactive. Less is often more. Another classic mistake: concentration risk. In every bull market, one sector gets hot and everyone piles in, abandoning diversification. It works until it doesn't. Think of the dot-com bust investors who went all in on IT, saw their portfolios wiped out when the bubble burst. Diversification isn't just advice, it's protection. Spreading your investments across sectors and asset classes shields you from disaster in any one area. You might not catch the hottest returns, but you'll avoid catastrophic losses. Bull markets make concentration look smart, but it's a high-stakes gamble. Don't bet your future on one sector. Diversify and you'll survive the downturns. Safety first, always. Time in the market beats timing the market, but that doesn't mean price doesn't matter. Buying a great company at a terrible price can leave you stuck for years. Think of Reliance in 2020. Early buyers made a fortune. Latecomers bought at the peak and saw no gains for a long time. Your entry price is your margin of safety. A bull market tempts you to ignore value, but overpaying is a handicap. Buy right, not just first. It's better to get a good company at a fair price than a great company at a crazy price. Don't let the market's excitement push you into bad timing. Anchor your returns with smart entry. Patience pays off. So how do wealthy investors thrive in bull markets? They stick to discipline, patience, and rationality. They invest with a margin of safety, never chasing what's already run up. If nothing's worth buying, they wait with cash. They diversify, never betting big on one hot sector. Their portfolios are built to weather any storm. They think in decades, not days, buying businesses, not lottery tickets. They ignore daily noise and let compounding work. Bull markets are a test of discipline, not a party. They trim profits, rebalance, and always focus on risk first. That's the real secret. Bull markets create the illusion that making money is easy, but it's discipline, not luck, that builds wealth. Headlines may celebrate new highs, but your results depend on your actions and strategy. Avoid the traps: late entry, overtrading, poor diversification. True wealth is built over a lifetime of smart decisions, not a single bull run. Next time the market soars, ask, am I following the crowd or my plan? In the end, strategy, not luck, separates winners from losers. Thanks for watching. Like and subscribe for more insights.